Inflation-linked bonds, also known as inflation-indexed bonds or Treasury inflation-protected securities, TIPS, in the United States, play a crucial role in protecting investors from the erosion of purchasing power caused by inflation. Here's an overview of the role and benefits of inflation-linked bonds. Protection against inflation. The primary role of inflation-linked bonds is to hedge against inflation. Unlike traditional bonds that pay a fixed interest rate, the principal value of inflation-linked bonds adjusts periodically based on changes in the Consumer Price Index, CPI, or another inflation index. This adjustment ensures that the bond's value keeps pace with inflation, thereby preserving the real purchasing power of the investor's capital. Stable real returns. By linking interest payments and the bond's principal value to inflation, these bonds offer investors stable real returns. Real returns refer to returns adjusted for inflation, meaning investors receive a predictable income stream that maintains its purchasing power over time. Diversification. Inflation-linked bonds provide diversification benefits to investors' portfolios. They tend to have low or negative correlations with traditional fixed-income securities like nominal bonds. Adding inflation-linked bonds can help reduce overall portfolio risk and enhance diversification across different asset classes. Risk management. Inflation-linked bonds help mitigate inflation risk, which is particularly important during periods of rising prices. Investors holding these bonds are less exposed to the adverse effects of inflation on their investment returns compared to holders of fixed-rate bonds, whose purchasing power diminishes as inflation rises. Government and corporate issuers. Inflation-linked bonds are typically issued by governments, such as TIPS in the U.S., and sometimes by corporations seeking to raise capital while offering inflation protection to investors. Governments use these bonds to finance public expenditures without exposing investors to inflation risk, thereby broadening the investor base for government debt. Investment considerations. Investors considering inflation-linked bonds should assess factors such as the bond's indexation method, CPI-linked or other inflation measures, maturity dates, and liquidity. TIPS, for example, are highly liquid and backed by the U.S. government, offering a secure inflation hedge for investors. Income planning. Inflation-linked bonds can be beneficial for income planning in retirement or other long-term financial goals. They provide a predictable income stream that adjusts with inflation, helping retirees maintain their standard of living and preserve the purchasing power of their retirement savings. Market and economic indicators. The performance of inflation-linked bonds is influenced by economic indicators such as inflation rates and expectations. Investors should stay informed about economic trends and inflation forecasts to assess the potential impact on the value and returns of their inflation-linked bond investments. In summary, inflation-linked bonds serve as effective tools for investors seeking protection against inflation while preserving the real value of their investments. They offer stable real returns, diversification benefits, and income predictability, making them valuable components of a well-rounded investment portfolio, especially in environments where inflationary pressures are a concern.